Dear investor, wish you all a very happy new year. At this juncture, let us look at what happened last year briefly and try and create a thesis for what may work in the new year. Calendar 2023 continued to be the year of value style of investing. This has been the case for last 3 years when the beaten down spaces have come back strongly on sustained government support. If we look at some of the strongest performance of 2023, they belonged to the PSU space in sectors like power ecosystem, which includes producers like NTPC and Neyveli Lignite, financiers like PFC REC, and new listings like IREDA, and also equipment makers like BHEL. Commodity producers like Coal India, Metal Ecosystem also did well with both PSU and private companies participating well. PSUs in defense space saw a strong momentum across the board. Many of these spaces still retain value and are benefited positively by the reform agenda. Some are reinventing themselves and making themselves ready for the long runway of growth go ahead. These spaces could hence continue to do well in this year as well. Now, calendar 23 was also a year when the high growth companies found their footing back. High growth as an investing style came back into focus as interest rates stopped increasing and visibility of growth became stronger. Companies in the new tech space, mid-cap IT services companies, hospitals, retail-oriented banks with strong AUM growth, engineering companies, companies in the luxury space, electric vehicles, renewable energy, these were spaces in which if a company was there, did quite well on the markets. The growth delivered, the earnings growth delivered by the broad market was much stronger than the growth of the narrow large cap indices like Nifty, and hence the broader market did relatively much better. In 2023, two large spaces did not perform very well in the index. These are large private banks and IT services companies. We were saying continuously in 2023 that it is time for alpha because we could take money out of these spaces and invest into other spaces where growth trajectory was higher. Highest quality space such as consumers did not perform well. We believe that the period we are in, beginning 2021, is seeing the highest growth in earnings that the market has seen from early 2000s, and in this manner this period is very different from the past periods. In the high quality, high growth space, companies providing hence higher growth quotient should be expected to continue to do well, and this is where our funds are positioned since we are high quality, high growth style exponents. The macro scenario underwent large changes during the year. There was uncertainty caused by Israel-Hamas war, while the Russia-Ukraine war continued. US and our country continued to see central banks increase interest rates, and higher for longer became the dominant thought. Bond yields in the US climbed briefly to 5%, and all the associated risks on this count came to the fore. Oil prices spiked twice to over USD 90 per barrel levels. Happily, however, many of these stresses got addressed as time went by. Oil prices have declined to sub $80 per barrel. Bond yields in the US have declined from 5% to now even below 4% for the 10-year bond. The outcomes of the state elections in 2023 have actually reduced the uncertainty around the 2024 general elections. On this count, let us look at the outlook going forward. There are several points that we note. One, Indian markets offer diversification benefit to global investors. Our performance has been very different, very divergent to other markets. While India has been one of the better performing markets of 23, the performance has the backing of good earnings momentum and good macro outlook versus other countries in the world. With domestic money coming into the markets through systematic investment plans in a structural manner, this money now being the key driver of the market, our markets are offering diversification benefits to global investors as their moves are delinked with the other large markets of the world. Depth of the market has also improved considerably, and it is possible to invest larger monies and also take out larger monies. Going forward, we believe that each global market would increasingly be driven by its own internals, and the influence of global factors could reduce. For growth investors, as yet, no other market offers the potential and choice that the Indian market offers. Coming down to outlook on valuations, we have a positive construct on the market going forward. Reform momentum continues to be strong, and so is the earnings momentum. After a long while, we have seen future earnings estimate hold as the year progressed. Valuations as yet are just about long period averages, so very sustainable to our mind. Given the sharp change in the outlook over the past 1 month as described earlier, unless some of the factors reverse sharply, we believe that this period could be the period when markets sustain higher than average valuations for a length of time. This is our thought. This is a period when markets can sustain higher than average valuations. Coming down to our outlook on flows, we believe outlook on money flow into the market has improved. FPIs have tracked the election outcomes and are more confident. Moreover, as US yields drop, there is a good chance of improved inflow into the emerging markets and India funds. Already December has seen strong FPI inflows. Since FPI flows are chunky, they tend to favor the larger cap part of the market. So, this we will keep in mind for performance. Domestic flows should continue to remain strong and structural. We believe that domestic investor is underinvested into equities, and with rising per capita incomes, it should continue to invest in a structural manner. SIPs seem to be the chosen instrument to invest. For the market followers, SIP flows are very predictable and they are rising strongly. Domestic investors seem to be favoring the performing part of the market. Small and mid part of the market is seeing strong earnings growth momentum, which we believe the stock prices are following. And this is the part which is now getting a larger part of retail, domestic, mutual fund oriented flows. Overall, hence we believe that outlook on money flow in the markets in the new year is good. However, at the same time, new issuance calendar is also getting stiffer, and we believe this provides a safety valve. It continues to be time for alpha, for sure. Our strong belief is that the market performance follows earnings performance. If we look at the long period earnings moves of the large, mid and small part of the market, we see that the current period is unlike any period since 2000s. In the earlier part of the century, growth was strong, but was more evenly distributed between the large and the mid and small cap parts. In the 2008 to 2021 period, on account of several disruptions like Lehman, bank loss recognition in India, IL&FS crisis, COVID, etc., Larger caps delivered small 5% earnings growth, while mid caps delivered lower 4% earnings growth, and small caps delivered still lower 3% earnings growth. This meant that index performed stronger, larger caps performed stronger than the broad market. In this period, highest quality businesses did well on account of presence of cash on books, while inability to borrow constrained growth in other part of the economy. Onward march of globalization made it very difficult for domestic Indian businesses to thrive, particularly in the manufacturing space. From the bottom of the COVID, China plus one sentiment has gained ground globally and helped with government support. Whole new ecosystem of manufacturing businesses is coming up. This is resulting in mid caps delivering stronger growth than large caps, and small caps actually delivering the highest growth quotient. Many of the investing themes are more present in the mid and small part of the market versus the larger part of the market. Another thought is margins could expand as inflation has fallen. 2023 has been the story of better margins, and this could continue into 2024 as well. We are still below peak margins attained in 2007, and that leaves room for improvement. Coupled with conducive policy environment, we could actually exceed margins we saw in 2007. Given the higher growth tailwind, the stock market performance should continue to remain stronger in the mid and small part of the market. Here we are very differentiated versus the street in our thinking. 2024 seems to be the year which holds a lot of promise and continuity in policy direction. Reduction in interest rates over the year should result, as we progress, in growth style of investing slowly gaining prominence. Calendar 24 could continue to see many of the same spaces perform strongly for growth investors. One, private sector capex should start to strengthen is the first thought. Capex did very well in 23. The first driver is housing, where unsold inventory has fallen to the lowest in a decade and warrants new launches that helps the builders and drive sentiment there. Second driver is the demand and supply gap for cement and steel, two largest drivers of capex in the private sector, and also power. Given the large peak power deficit, should kickstart industrial capex. Lower corporate leverage and buoyant cash flows support the capex. What is the validation for this? Well, there is buoyancy seen in bank sanctions towards private sector, and this points to improved capex outlook from the private sector in the capex space. A good way to address this space would be to be exposed to players who are diversified or whose products go into a diverse range of application or are exposed to the strongest growth spaces. This would improve the predictability of the revenue and profit streams. On this count, we believe that large MNC, can source from the parent and address a very large opportunity. Domestic engineering companies could be one way to benefit as they are diversified. On the domestic side, we want to focus on managements with strong ability to seize opportunities coming their way. So, the driver is different for MNC companies and domestic. MNCs, we believe, can source more verticals from the parent in terms of newer cutting edge technologies. Domestic, we believe, will have to seize opportunities in adjacent spaces, maybe newer spaces, using the cash flows of their existing businesses. So that is the trait we want to see in the domestic businesses. In this space, it is very clear that MNCs are gaining market share, and hence the way forward for domestic players is to diversify. into newer spaces. If we flesh out narrower themes, power cable companies could be offering a cheaper way of benefiting from the same capex themes. Cables go into a wide spectrum of capex spends and hence offer a much more steadier growth. If you want higher quantum of growth in renewable energy spaces in verticals like wind, pump storage could experience strong growth. Even coal-based power producers could see strong order momentum because of some amount of order backlog which has accumulated. Import substitution is a big driver of growth, especially from the bottom of COVID. The government has been able to provide protection. The thought of the day is reverse globalization and self-sufficiency, and hence this offers a steady source of growth. In this space, defense should continue to show traction given the geopolitics of the day. Now, in the capex space, MNCs are investing strongly into newer factories, and that is good for job creation. However, this space is largely unlisted. In the capex space, one should look at private sector taking the baton from the government in terms of growth driver. Consumption in this period could continue to lose market share as a percentage of GDP. This has been happening for the last 2 years, could continue deeper into the future. The headwind to consumption is fiscal consolidation also. Over the next 2 years, if we see fiscal consolidation to 4.5%, for example, of fiscal deficit, it would imply lower growth in government spending, including capex. So on capex, private sector supports, but consumption gets impacted. Another interesting trend that we have seen is that saving bank accounts are seeing deceleration in growth. Consumption is broadly funded by withdrawal from these accounts. This, coupled with slowdown in personal loan growth on central bank intervention, should result in small ticket private consumption and even larger ticket, for example, wedding related spends, to deliver muted growth. Lower job growth in tech services could also prove to be a dampener. That's the biggest hirer from colleges. Faster growth categories in consumption such as cell phones and other electronic items are not well represented in the market. There are a few things working for consumption, though elections have always resulted in expansion in money supply, and this year again it could happen. Also, there is a wealth effect on account of better equity, gold and property prices. So that should again help consumption. Now, as a house, we are invested into niches in these spaces which are growing strongly, such as 3 spaces. Let me point out: food delivery companies. This continues to show strong traction. Luxury consumption categories such as hotels, malls, jewelry companies, etc. Electronic retail, so electronics is the largest growing category. Shops which are vending out electronics stand to benefit. Now, large banks and IT services have not performed in 2023, and this trend could continue in the new year. This is because a central bank rate cut in the West could be seen as an evidence of slowdown in the economy, which would again constrain tech investments. Large banks face margin headwinds as interest rates decline, and also as lending picks up in lower margin corporate loans. However, both these spaces may benefit from strong FPI inflows, and cuts in interest rates would make growth assets like Indian equities more attractive. Overall, a very interesting year ahead. There is a great chance that both style of investing, value and growth, do well, with growth style gradually finding better traction as interest rates decline. We continue to believe that markets overall would follow earnings growth, and we are invested in some of the fastest growth spaces in the market. On this note, wish everyone a very happy new year. Happy investing. Thank you, investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.